All right, this is Ubaid on behalf of Electronics, and in this video, we'll be talking about strategies to avoid bankruptcy, okay, when it comes to banks. Okay, some of these strategies that banks use when it comes to bankruptcy, they include but not limited to, okay, number one, loan diversification. Number two has to do with selling some of the loans or selling loans to the secondary market. And number three has to do with, okay, buying bonds as well as reserves. Okay, so making a deposit in the reserves for unforeseen events. Okay, so again, loan diversification has to do with diversifying a loan. Okay, when it comes to an economic downturn. Okay, what they mean by economic downturn is if you have a recession, for example, okay, or an inflation. Okay, now if you have an inflation, okay, the money will be devalued, okay, spending will go down, investment will go up, as a result of which, okay, the banks won't be receiving as much money as you would expect, okay, when the economy is growing. Okay, when it comes to receiving money from products like mortgage loans, okay, products like line of credit, personal loans, auto loans, so on and so forth. Yeah, because people are not able to pay on time, okay, people may delay their payments. Okay, people may not be able to pay, which means they may face foreclosures, as a result of which banks may suffer. Okay, people may not be able to pay, which means that they may not be able to pay for a long period of time. All right, as a result of which, okay, what the banks may do is they may diversify their loans. Okay, this is to protect themselves against inflation or recession. Okay, so banks, they diversify their loans. Okay, they diversify their loans. And they diversify loans by offering both individuals as well as businesses in different locations and different geographic areas. Okay, so offering loans to firms and individuals. Okay, and the second part to this is selling loans to the secondary market. Okay, so this has to do with selling your loan to a secondary market, which would be organizations that are backed up by the government directly or indirectly. And we're talking about financial institutions. So when you sell these loans to the secondary market, hey, what's going to end up happening is the banks will receive a lump sum. Okay, they will receive cash for the product. Okay, the secondary market will go ahead and bundle these loans. They will put them under mortgage-backed securities, for example. Okay, and they will sell them to other institutions such as your insurance companies, as well as institutions that deal with pension funds and mutual funds. Okay, so they will sell the loans to the secondary market, so that way they can get some cash for liquidity. Okay, and save themselves from bankruptcy. Okay, so sell it to aggregates, sell loans to aggregates, such as mortgage loans to aggregates. or financial institutions. All right, now when it comes to buying bonds and reserves, okay, when it comes to investing in reserves, the government, okay, does buy bonds through the central bank. So the central bank may buy bonds from the banks. Okay, and likewise, the banks themselves, they can buy government bonds as well as invest their money in reserves. Okay, so we have local banks buy bonds. Okay, we're talking about low risk bonds, such as government bonds. Okay, low risk bonds and invest their money and invest in reserves for unforeseen events. All right, so these are three ways that the banks, or three strategies, so to speak, that banks use when it comes to avoiding or preventing bankruptcies. And that would be it for this video. On behalf of V Electronics, this is Obey. Have yourself a great day.